Well, I'm here today with Daniel from Prerequisite Capital Management, and we're here today to talk about some of the essential concepts behind the way in which you as an organisation function. And I guess the question is, everyone needs to generate investment returns, but how do we do that in a way that is conservative and safe?
Yeah, so it's a pretty complicated world out there. There's a lot of moving parts, and in order to generate returns, obviously we need to take some form of measured risk. And so how do we start to think about taking measured risks in a world that is so actually complex and unpredictable, and with so much often crazy stuff going on?
Yeah.
And so there's a whole series of sort of common sense principles that we tend to lean on in terms of establishing a foundation of resiliency in our portfolios. And that enables effectively us to be able to manage risk, generate returns through in environments where there can be quite a lot of unexpected happenings.
And I guess over the past 50 years, the world has been quite complex, but where we're at now is a very unique time.
So when I sat back and looked at what was happening in the world, it was reasonably clear that we're in a rather unprecedented credit cycle globally on a multi-decade basis. And part of the realization with that was that, fantastic, I'm going to come into age, so to speak, especially as an investment manager in a world that is dealing with the consequences of a lot of these excesses and over-indebtedness, and governments everywhere promising more than they can deliver on, all sorts of issues. And so the stable regime of the last 50 years, roughly, that we've had globally in how the economic system has kind of worked and functioned, and even especially trade relationships in the world and the way capital is moved and the financial interdependencies. The next 25 years is just not going to be like what we've kind of experienced with that upswing in that credit cycle that's sort of lifted all boats and helped us to kind of paper over all sorts of unsustainable issues in society and in different economic systems and push them off into the future, and so here we are, and we're sort of staring down the barrel of the next decade or so, having to navigate the consequences of pushing all of those things into the future, all of those unresolved issues and unsustainable imbalances that have kind of built up over the last 30, 40 years.
So if the next 25 years are going to look very different from the past 50 years, how do we then think about the way in which we interact with
or even understand the world?
Yeah, absolutely.
So that was one of the things that, even 20 years ago I was increasingly wrestling with. Because in an over-indebted environment, and especially the way policymakers even back then were behaving, because they basically pursue policy that pushes off pain into the future. If the system starts to become unstable, or any form of pain in terms of a debt default cycle, or recessions, or unemployment risk, or any of these things, immediately their reaction is to drop interest rates and do a variety of different things to dampen the pain and then push it off. And so what that is fundamentally doing is heading in a direction that is disengaging the counterbalancing mechanisms of how markets function. Because markets function to ultimately reallocate resources from basically poor uses or poor stewardship towards better stewards. And a fair and functioning market system tends to do that. Over time, that produces the sustainable and effective allocation of resources to be able to produce the growing abundance of goods and services that lift our living standards as a society. And so by impeding that market functioning, it basically stores up a cumulative set of issues which means government, especially the way they're incentivized and the way politics kind of works, they need to get more and more desperate to continue to hold all of those building dynamics at bay.
Yeah.
Now, what that practically means is the last 50 years, one of the paradigms that's worked really well is like a traditional valuation sort of investment paradigm, because and that's really a mean reversion type concept.
Right.
When things get really undervalued, that's when you basically accumulate a boatload of the stuff, because inevitably, especially in a rising tide of a growing and building credit cycle on a multi-decade basis, that mean reversion inevitably kicks in. And if the property rights are still roughly stable and the rule of law and all of that sort of things that underpins trust that the economic system is built upon, we still have a bit of a foundation. We have that tailwind to progress and to help that mean reversion sort of ultimately always kick in. The problem is by artificially dropping interest rates and stimulating at the drop of the hat in the different forms that policymakers have, eventually you erode the market mechanisms that make a lot of these economic systems actually work. And so a valuation paradigm, for example, is still useful as context, but in a world that is becoming increasingly disengaged from a market mechanism perspective, it's more about the movement of money and capital flows that start to gain ascendancy in the paradigm. And so it's sort of like, you follow the money, watch where the money goes, and because sometimes in that disengaged world where market mechanisms are increasingly being suspended or disengaged, markets are going to move in ways at times that are somewhat counterintuitive, right? And so the only way to really wrestle with that and really operate within that is to watch the way money moves and behaves as an increasing sort of focus in a paradigm moving forward.
Right, of course. Some of the market mechanisms that a lot of investors would make decisions on over the past 50 years, moving forward, may not be as effective.
Well, that's right, because most of the current way that, say, the broader professional industry will operate today is optimizing to conditions that existed in the rearview mirror, like over the last 50 years, right? But when those conditions are fundamentally shifted, they're going to increasingly find themselves, without ways to be able to understand or even navigate from an investment perspective where we're heading.
So we've talked a little bit over the years about the importance of protecting wealth, and given that there has been this focus on wealth accumulation, and so to speak, kicking the can down the road, there is coming a time where we need to be, there probably has already been a time where we need to be thinking about wealth protection. And so how do we guard against the unexpected changes that might be in the foreseeable future that could cause us to lose our wealth?
Yeah, so the first thing we need to do is actually step back and understand what sort of a reality we're dealing with when we're looking at the world to understand it. Most of academic theory around how the world works is quite mechanical, two-dimensional, and sort of sidesteps a lot of the realities that are awkward to deal with, like the fact that we have thinking participants with free will that can make arbitrary decisions based on mood or feelings or different agendas. Basically it's a complex adaptive system.
Right.
The difference is most people understand, or at least have a little bit of an introduction to complexity type dynamics through a natural sciences sort of background. One of the more prominent physicists in the natural sciences observed before he passed away, unfortunately, what would it be like, and this is paraphrasing, what would happen to the laws of physics if electrons could think? Right? Because all of a sudden, like my father's an engineer, and engineers, if they were to build a bridge or a building or some industrial plant type application, 1 + 1 always equals 2. right? They have a natural law, and there's some bedrock
Absolutely.
sort of laws and principles in there that are very predictable and you can build a bridge with. In our world with thinking participants, 1 + 1, sometimes it equals 3, sometimes it equals -5, depending on where the different participants are at in their thinking, their feeling, their ability to express themselves and make decisions. And so we'll observe reality, we'll make a decision, and then we'll act and change the reality, and then we'll observe it again, and then we'll act, and so we have this feedback mechanism that means that social and economic systems are very different to complex systems in a natural science or a computing type setting, depending. The reason I mention this is that it's fundamentally a complex adaptive world out there. We need to understand it as a system where everything's interrelated, interdependent. The common denominator is people and behavior, and that's one of our pathways to a solution in terms of how to navigate, gain insight into, and even at times, sort of front run or be a step ahead of certain more predictable behaviors. The other thing that we probably just need to clarify, because whenever we start talking about this with people, helping them understand the distinction between a complicated system or a complicated situation and a complex system and situation is actually a very different thing. So in a complicated situation, it can be analysed and it can actually be solved, right? And so this is what engineers basically are really good at, or computer programmers. They can take a complicated situation with a multitude of variables, but there is actually, in a mechanical kind of analytic way, a way to arrive at a solution or a way of understanding. A complex adaptive system cannot be fundamentally solved, right? There's too many moving parts, there's too many adaptations. We've got that thinking participant problem as well. So it's like in physics, if electrons were thinking, all of a sudden all sorts of havoc starts to unshoot. So when it comes to complex systems, it starts to become a situation where we need to be a little bit heavier on, some of the first principle sort of building blocks that tend to relate to behavior and the human element that's common denominator in all that, but also pattern recognition and being aware of the adaptability of people. One of the lessons of history is that often a society or a group of people will, do things that are unsustainable. They'll take themselves to the brink, look over into the abyss, but then adapt more often than not, or find a way to shift the bill or pass, kick the can down the road or whatever. Now, sometimes they lack the flexibility to adapt, and in a lemmings-like way, they go over the cliff into the abyss, and there's still plenty of examples through history in that sort of regard. And so, practically speaking, what that means for us is that we need to be more open and cognizant of the patterning, the behaviors, and that potential to adapt in that multitude of ways. And that opens us up to all sorts of possibilities. We can predict what an unsustainable imbalance will likely lead to, and we might have that right several years in advance. Doesn't necessarily mean we'll get there, because society and that complex system can adapt in different ways and eventually get to that point of recognition and really adapt. The distortions that are introduced could be quite extreme, which ties us back to the direction of policymakers in suspending market mechanisms. But then the solution still is in observing the behavior of people, having a look at the incentives. So the other rule of, when you study people, that when character fails, incentives prevail, right? And that applies to governments and individuals and businesses.
That comes back to that statement you made at the beginning, follow the money.
Well, people past a point, especially in aggregate, are more predictable and more understandable than is commonly realised. Like, people don't change, human nature doesn't change, and where character is absent, incentives really do direct, their behaviours and likely courses of action.
We talk a little bit here about these two distinct systems, a complicated system and a complex system, and I guess trying to gain an understanding of that for people is that a lot of people's approach to market, a lot of investors' approach to market, looks at it from a very rigid.
Yeah, it's a very two-dimensional rear view mirror sort of view of things in the way most investment paradigms operate.
Yeah.
Now, they try to counter for the weaknesses of those things, but it's a very contorted way of looking things when you don't embrace the fact that we are dealing with a complex adaptive system and with humans.
Yeah, absolutely.
But the more experienced operators will tend to intuitively start to incorporate that sort of understanding.
Yeah.
Now, whether they can articulate it and realize, consciously that that's what they're effectively doing can be a different thing.
Right.
Like George Soros in his, George Soros, when you read his Alchemy of Finance book, which is kind of one of on the list of must-reads, he's effectively a systems thinker, a complexity analyst. Not that he would describe it that way, but so he's intuitively operating out of these paradigms, and obviously he has the results to attest to that. Now his politics are totally different, but he's a class act when it comes to analysing markets, especially at a more tactical level.
And a lot of people who approach markets approach it from this efficiency model, as opposed to maybe what you're talking about sounds like more of a resilience.
Yeah, so when we study natural systems and ecological type systems and complexity, one of the things we realise pretty quick is that there's two sets of characteristics that any given natural system has. You've got resiliency characteristics, which is that flexibility, that ability to adapt to unexpected change, positive or negative, whatever. And then there's efficiency characteristics, which is kind of that performance-orientated ability to thrive and reproduce or drive towards whatever the mission or the goal is of that system.
So the natural world has these systems built into them.
Yeah, the intriguing thing is that the key to surviving over time, surviving and thriving over time, is you need to get a balance, the right balance of those two sets of characteristics.
Right.
And that window of viability is actually quite narrow. So too far into the resiliency spectrum, you become not efficient enough to actually survive, and you kind of become obsolete as a system, or the natural systems that you find out in ecology. Too far in the efficiency side of things, you become too inflexible and you can't adapt. And so often unexpected change, or just even the natural repetition of cycle, can actually break and destroy that system, can be catastrophic. The window of viability is roughly 2/3 resiliency characteristics, 1/3 efficiency characteristic. Now that's a little bit counterintuitive to the way we operate as society, either at a national level or even the way we run businesses that are geared towards efficiency and profitability first and foremost, with almost total neglect of resiliency type characteristics. And over multiple cycles, resiliency can actually become a competitive advantage in its own right, because when a crisis or the bad times or tough times come, if you're still resilient, you're able to adapt through it, but your competition, too efficient and not resilient enough,
rigid,
they are at risk of being wiped out or severely impaired, whereas you're able to adapt and even expand into that situation.
That's great.
And from an investment point of view, we talk a lot about the storehouse principle.
Yeah, great.
Which is effectively just expanded upon from the book of Genesis in the Bible, where Joseph, there's the 7 years of plenty and the 7 years of famine. He stores up corn, basically, which was effectively like the liquid money or purchasing power in the day, especially knowing a famine's coming along.
Yeah, absolutely.
And so he stores that up during the good times. And so when the bad times come, he has that resiliency, that purchasing power intact, and the liquidity, so to speak. He has money when no one else does. Right. And as the bad times unfold, as the pain starts to set in and get worse, and a lot of the countries around about where he was set are basically being wiped out, asset values are being destroyed, etc., etc. He was able to then open up the storehouse with that purchasing power, which was corn, which was actually incredibly rare in that in half the known world back then for
right.
cents on the dollar.
Yeah, wow.
Which is a very conservative way to compound wealth over many cycles.
So the importance of actually
being resilient
and building into your portfolio the ability.
These principles,
Oh.
is just essential. So you're starting to establish, a lower risk way of operating within a complex and dynamic world. With a lot of uncertainties, and there'll be good times and bad times, and every 7 to 10 years on average in most countries and just around the world, you'll tend to have some form of a crisis or a recession or some sort of a tough time come through. And so if we can operate and actually be in a strong position even when they come, because we're a little bit more skewed to a resiliency type philosophy and focus.
So how do we create resiliency? What are the practical ways in which you do that inside of a portfolio?
Yep, so every single asset class in this world, whether it's a currency or bonds or equities or commodities, even all of the major asset classes and components that you'd go or consider for a portfolio, all of their performance is driven largely by 3 basic factors, right? That is growth, inflation, and capital flows. So at any given point in time, it doesn't matter what happens in the world, we can have some sort of left field event hit us or whatever, and that could have positive or negative implications. It's just going to rearrange the composition of how those 3 dynamics are acting. And so that will benefit some asset classes and penalize others.
Right.
So for example, when growth is increasing, so economic activity is expanding, people are confident, taking on risk, they're buying things, they're investing into stuff, whatever, equities tend to do really well.
Yep.
All right. When growth is falling, cash is king, and so when inflation is increasing, tends to be things like precious metals and real assets and things tends to do really well. When inflation tips over into deflation, long duration government bonds tend to do really, really well, right? And then capital will be either concentrating into an asset class or dispersing away, or concentrating into a region or dispersing away, for varying different reasons. And so even at a currency level, if we can basically hedge our domestic currency devaluation risks by having some measure or some small allocation to external foreign currencies, or even gold on precious metals again is another hedge to that domestic currency devaluation risk. And so if we get some sort of left field, unexpected negative surprise in the world that happens, it's just going to rearrange those 3 primary elements, or their direction, so to speak. And so if we have an allocation within our portfolio as a starting point to equities for when growth surprises on the upside, obviously maintain some cash for when growth tips into recession or a negative shock in the world that hits growth. We have some precious metals for when we get the currency devaluation or inflationary type excess inflation conditions. Longer duration government bonds for any deflationary type shocks, especially banking system risks or over indebtedness risks that create some nasty surprises if we've kind of miscalculated things more broadly in the general system. A little bit of foreign currency, but also that dovetails as to why precious metals can work as well for the currency devaluation risk. And so if that's our starting point in terms of diversification, that gives us a resiliency.
Yeah, there's a resiliency built into
whatever happens in the world, we'll just rearrange those primary factors. Something will go up, something will go down, but across the board, it nets out to preserving our purchasing power or preserving and protecting our capital.
Absolutely.
And so that gives us a first principles foundation to be resilient. And in investment speak, it means we're not correlated to anything with that foundation, that set of diversification. And we have very low volatility. And so we're preserving and protecting the purchasing power of our capital, irrespective of what happens in the world. So we don't have to predict the world or its complications or its complexities or the curveballs that get thrown. We have an answer for it in our portfolio.
And you built that storehouse.
And that effectively enables us to leverage the storehouse principle over multiple cycles.
That's brilliant.
Because when everyone else kind of gets cut in half, or there's a deficiency of cash out there, or people are scared, or whatever, and good quality assets trading for cents on the dollar, or they're on the cheap, we and our clients and our portfolios have the purchasing power intact to be able to step out and step into and accumulate some of these high quality assets that are trading at bargain basement prices. You know, just like Joseph did effectively in that story from a few thousand years ago. And so it's same old principles, but over multiple cycles, it's a very conservative way to really build wealth. Because every cycle, coming out of the cycle, if you've been able to preserve your purchasing power and accumulate those high quality assets, whether it's real estate or businesses or shares or whatever it is, when we come out of that cycle, you get this uplift, this step up function in the wealth you have. You know, and even in your business, if you're aware to these resiliency type concepts, good shot that quite a few of your competitors have either gone to the wall or are severely impaired during that downswing in the cycle, or that negative, the tougher times that occur every so often. And your position to even expand into that setup.
And the importance of liquidity is at that point is so important too, isn't it?
Absolutely. So liquidity is a form of flexibility. Right? And so the more flexible we are, the better we are able to adapt to change. To avoid risk and take advantage of opportunities to basically gain the initiative in whatever field of endeavor we're in. And so trying to avoid a situation of inflexibility is quite key, especially at key points in the cycle, but also as a general philosophy in what we do. Because if we have too much debt, or too much, we're operationally over leveraged, or whatever it is, we have inflexibility to be able to adapt probably when it counts.
So some of these conversations about resiliency that we've been having really map back or track into this concept that we've talked a lot about in the past, about this idea of being anti-fragile. Can you explain that?
Yeah, so the idea of antifragility was kind of recently made popular by a gentleman by the name of Nassim Taleb. Interesting guy, but very, he's made quite a contribution through many of his books. So obviously, to be fragile means that it's easy to break or fall into disorder or have catastrophic result, when unexpected change occurs, especially negative change, etc. And so being fragile is like being inflexible. You have no ability to adapt. If some curveball hits you, you're going to be like glass and you'll just shatter. It's fragile. Antifragility is the concept of effectively being able to benefit from stress, or have a negative shock or surprise or curveball actually be a huge positive for whatever you're doing or for the system. And so in an investment context, that means that we want to be structured in a way where if the tough times come, or we have a crisis or a huge bout of volatility in different markets, so we want to actually be able to benefit from that. And so it's obviously we structure at a foundational level for resiliency according to those diversification style principles and the primary drivers. But what we really want to do as well is have a measure or move towards the ideal of being anti-fragile. So we want to actually be able to benefit and even turn those storms into tailwinds to be able to sort of soar through them in effect. And a classic example of that has always been quite vivid for me is that, eagles, basically. So an eagle, if there's a storm front coming or a storm coming, they'll actually just lock their wings and fly into it, and they'll actually have fun during the storm, soaring through all of the different currents and all of this sort of thing. And so that idea of being able to even glide through and have fun, or probably having fun is the wrong way of putting it, but to benefit from and turn the storm into actually a tailwind of performance for our portfolios.
Great.
is pretty significant. It's a pretty powerful idea if we can move in that direction.
Absolutely.
And one of the best ways to do that is it's sort of like a philosophy I've kind of increasingly realized over the years, that it's better to be long a solution than short a problem. Right now, long and short are two market terms, where if you're long something, you've bought it and you're expecting it to gain in value or the price to rise. So I've gone long that stock or currency or whatever it is. If you're short, you've actually sold it first and you're expecting it to fall.
Yeah.
You make money by buying it at a lower price later. Shorting stocks or shorting most things is actually, it's much more problematic, and there's a lot of natural headwinds against you succeeding in that sort of a dynamic. It's better to be long something that actually benefits from that problem.
Right.
So to be long the solution, I want to own a solution to this issue rather than being short a problem.
Right.
You know, when we are in a world which, you know, we're largely in, where there's a lot of issues in the global banking system, and the broader currency and banking system environment is reasonably problematic. And so being long a solution is being long the collateral that underpins all of that broader banking and financial system. So if we own the collateral before everyone else realizes that they're going to need it, you know, so when stress hits, they're going to scramble for that collateral.
Yeah, that's right.
We already own it. We'll gladly give it to them at a higher price. But that gets into that concept of everything in the world, whether it's currencies, bonds, equities, everything is either a collateral or a confidence asset.
Yeah.
Right now, so a collateral asset is sort of this concept of being like security, secure, safe. It's what everyone wants in times of stress or uncertainty. It backstops or is a counterbalance. It's a solution for whatever is the issue. You know, in different times in history, property could be a collateral asset. Especially in inflationary times with not a lot of debt in the system, but there's problems in the public sector or the government or whatever, property can actually be a collateral asset that you want to own or scramble to, or that the system will want to scramble to in times of stress. Presently, in most of the developed world, property is not necessarily a collateral asset, it's more of a confidence asset, because it benefits when times are good and better, and confidence is out there, people are taking more risk, mainly because of the amount of debt that underpins property as an asset class, generally speaking, these days. And so in the current regime, it's more of a confidence asset. And so it sounds like a funny or an oversimplistic distinction, but it's actually quite important when you're running portfolios. You need to understand the interrelationships and the interdependencies of the economic, banking, and currency systems to be able to identify what are, in substance, collateral assets or collateral currencies even, versus confident assets or confidence assets and confidence-driven currencies, right? Because if you understand the distinction between the two, and you can only fully understand that through a systems lens, not analyzing the asset or the currency or in isolation, but the interrelationships around that asset or that currency or whatever it is, and the interdependencies in the system, to understand whether functionally that's a collateral asset or a collateral currency or a confidence asset. And it can make all the difference, especially in tougher times, but even in good times.
Understanding risk.
Well, that's exactly right. And the understanding of risk typically is in all of those interrelationships and interdependencies that form.
Right.
It's the systems view. It's looking at the world as a system instead of as some sort of a mechanical, isolated sum of the parts type concept. But it's the interrelationships and interdependencies that define risk and even opportunity. So with interdependencies and interrelationships being so important, and understanding feedback loops and a systems view of things and an adaptive nature of that system, especially with thinking participants, this is where we trace back to the beginning of our conversation with capital flows, right? Following the money, because all of these interrelationships, you ultimately can see them, and the world doesn't necessarily make rational sense, right? It's not, the world is not rational, but there is a functional rationality about the world and how it works and how people even behave. And so, one of the things, for example, that people underappreciate, especially, if we track back to the beginning of our chat around valuation type paradigms or even equilibrium type thinking from an economic perspective, valuation is an effect, right? It's a secondary effect. The cause is the capital flows in the first place. So where capital is concentrating into an asset class, that will cause valuations to be bid up. So valuation multiples will expand and all of this sort of thing. And it can become overvalued pretty quickly across most reasonable measures or perspectives. The problem is, if those feedback loops are still intact, those interrelationships that are driving this functional behavior that is causing capital to concentrate into that asset class or that country, it can go from overvalued to ridiculously overvalued to just, what the... and it's a function of understanding behavior and capital flow. And if those feedback loops break down that are underpinning that capital flow or concentration, then the market turns from becoming overvalued to potentially quite the opposite. Because those feedback loops can kick into...
so that something's only worth what somebody's prepared to pay for it.
Well, yeah, and even that betrays the fact that we need to be more attuned to behavior.
Behavior,
to
of course.
Functional rationality, to adaptive sort of capacities of people following incentives.
That's right.
And following the money. It's like all of those old sort of principles and proverbs to the effect of, show me your schedule and I'll tell you what's important.
Yeah,
so
great.
Don't, or the old rabbinic principle of, don't tell me what you believe, let me follow you around for a month and I'll tell you what you believe.
Yeah, brilliant.
And so you watch what people do and what participant groups are doing as opposed to what they're saying or thinking even, or even what we're collectively misunderstanding about the world. We can see what these relationships are, the incentives and the way money actually moves and behaves and is clustering or dispersing. And we can actually observe more about what is actually reality than what the majority are thinking is reality.
And so most people are reacting instead of taking a step back and being preemptive and front-running.
Yeah, absolutely. The other thing too is that in a world where policymakers are disengaging market mechanisms, so that all the different counterbalancing dynamics in a properly functioning and just marketplace, if they're disengaging those counterbalancing market mechanisms, especially to delay and defer pain or imbalances even longer because of different political dynamics, then following the money is even more important because you can get suckered into these value traps where something's really cheap. But because of these disengaging or suspension of market mechanisms, or central banks creating too much excess liquidity from a public source, can create all sorts of distortions which you won't see from a valuation or even an equilibrium or a mean reversion paradigm, but you can only see from a capital flows and behavior paradigm. And even if it sounds a little bit like a momentum dynamic, for market practitioners out there, but it's actually not that at all because you can't see the health or otherwise of a momentum dynamic. You can see its effect, right? But you can't be confident in its sustainability or its health or anything else. But if you look at a deeper core level of participant positioning, money flows and capital flows and the feedback loops that are underpinning it, then you actually have insight into the health and the dynamics, the sustainability of trends or otherwise, or even the vulnerability of trends because you see that weaken in the underlying liquidity, the underlying flows and excess positioning before you see it in price. Right? Money moves before price.
So much of this is common sense, and it really is a common sense approach in many respects, but requires a lot of thinking. And I guess a lot of the questions people might have is how does this actually apply in a real world scenario in terms of managing a portfolio? How does that look in a...
So the most powerful things in this world are often the most simple.
Yeah.
And the good thing about simple things is that if they get disordered, it's easy to reorder them.
Yeah.
Simply.
So true.
And so we try to keep things simple to some degree. Now, obviously, if you've seen any of our research and what we actually do, we go quite deep, even though we are quite simple in how we run
absolutely
money and portfolios. So in that philosophy of keeping it simple, like one of the tables we frequently use is this 7 primary risk table, and it just kind of illustrates these primary factors and then how you evolve a solution for that. So if we jump through, so these are the 3 primary conditions: growth, inflation, and capital flows. So when we have a risk of recession, the best solution that we are long to offset against that risk is cash or short duration income, fixed income. Underestimating growth prospects, the hedge is equities. Excessive risk of deflation, sovereign bonds. Excessive inflation risks, precious metals, real assets. The risk of a local currency devaluation, foreign currency. So as we talked about before, this is our starting point. Gives us a really good diversified foundation to preserve capital. Now this is, if you're familiar with conventional industry practice, they actually only construct portfolios effectively to account for maybe 2-ish of these factors.
Right.
And they're not accounting for the broader array of conditions that this world can adapt through. Obviously, there's another risk at the bottom here, which we kind of have to point out, and that's jurisdictional risks. So if you're in a country or a region where your government becomes excessively agenda-driven, the rule of law starts to deteriorate, becomes not as predictable, and you can be an increased risk of capital controls or confiscation or excessive taxation or regulation or whatever. We can't protect too much in the portfolios for that risk. We do only restrict our operations or the securities we own to developed world stock exchanges.
Yeah.
So securities that are listed on developed world stock exchanges. We only invest in or hold long only, big, boring, highly liquid stocks or ETFs or bonds that are listed on the exchange. That way, that gives the benefit to all of our clients that if they want to basically convert to cash some or all of our portfolio because of an unexpected event, they can do that and they can have the cash back in their account in 5 to 7 business days.
Yeah, wow.
And so we want to give that flexibility. We also operate in a separately managed account environment, which means we don't actually touch client monies at all. We just advise on the securities composition to achieve these performance objectives. That means that they can log in and see the securities and the investments they own 24/7 and have direct access to that, direct control if they need. And their accountant will love them because these platforms will provide them with an audited tax pack at the end of every financial year.
That's great, yeah. Wow.
All of this sort of thing. So we've tried to create a solution that, like I say, it kind of was good enough for our own family and friends, and we figured that other people would like it too. And so in moving on from here, what does this look like in practical reality? Well, this is a standard or an industry standard sort of return versus risk. Now there's many ways to define risk. In this situation, it's risk as defined as volatility, so how much the overall portfolio value fluctuates. So the idea, even though it's a very poor idea, as defined by the industry, that risk is a function of fluctuation or volatility. So the share market, at least over the last 7-ish years, has had an annualized volatility of about 14% roughly, which implies a higher degree of risk. It's a greater roller coaster ride. Our portfolios have been, less than 60% dampened to that risk. Or if you define, say, increased return, less risk is basically what all of these principles come out to.
Yeah.
If you define risk as drawdown, so if your portfolio value is going up, but then it has a drawdown, and so over the last 7-ish years, the share market has had up to a 28% fall. That's quite the roller coaster ride, and it induces a lot of clients or investors to actually make poorer decisions when they have to deal with that sort of an emotional roller coaster. There's also no guarantee that when you go into a drawdown, whether it's in the share market or different strategies, that you're going to come out the other side, right? There's plenty of share markets around the world that have gone into a drawdown and have not actually made new highs.
Yeah.
And because we've kind of got common sense solutions to all of these unpredictable negative surprises, we kind of have more of that resilient foundation. So we have a slightly greater peace of mind that, okay, if there's a banking crisis or there's some sort of left field whatever, at least we have some sort of common sense answer for that within the way our portfolios are diversified. Now that translates to, obviously the share market has produced an average annualized return of about this much for the last 7-8 years. Our portfolios have produced a higher return but substantially less risk.
Yeah, wow.
And we've done that only being long securities, so there's no derivatives, no leverage, we're not shorting things, we're not shorting stocks, for example, just simple, big, boring asset class kind of allocation and selecting some targeted securities to complement, the build out of our resiliency objectives. And it's all liquid and transparent.
It's a compelling solution and in terms of a risk-adjusted return.
Yeah, and so that's one of the things that people don't think enough about.
No.
And unfortunately, most people are not trained to understand this, but for every unit of return a particular investment strategy or a portfolio is generated, how much risk was actually taken to generate those returns?
Yeah.
Now, if you're more experienced in markets in the investment profession, you'd be well acquainted with being able to assess how much risk was actually taken to generate returns. Generally speaking, our risk-adjusted return rate is quite compelling, relative especially to most conventional ways of running portfolios and manage money.
Absolutely.
And it's by design because we're taking a lot of very simple common sense principles quite seriously.
But you're also a systems thinker as well, and over the years, a lot of people might not know this, but you've been mentored by some incredibly well-equipped thinkers in the area of systems.
So even though our portfolios are predicated and built on a lot of simple principles, and that probably drives 60 to 70% of the results, in all fairness. The balance of things in how we manage portfolios, manage risks that may not ever occur sometimes, but we still need to be aware of them and have a solution for them within our mix of assets. You can only see them through a deeper dive into a systems sort of paradigm of what is going on in the world and understanding. Now, there's the old principle that, I'd prefer, as opposed to someone with 20 years of experience in a field but unguided experience in a field, I'd prefer 3 years of guided experience under a master, right? And another principle of, that's pretty helpful in most fields is that if you want to learn about a field, you find a master and you offer to carry his bags. That's what you're getting at in terms of, many years ago, I sort of stumbled into this broader field of, systems analysis, systems thinking, problem solving in a complex environment. A complex situation, which might be a broad, large business, it might be a logistics, production, supply chain, or whatever it is. There's actually an amazingly well-developed field of systems analysis principles which teach you how to deconstruct, understand the complex system at play, get to the core root drivers of things, evolve better breakthrough solutions, how to better analyze and adapt within a complex adaptive environment, etc., etc. And so one of the leaders in this field globally is a gentleman by the name of William Detmer, or Bill Detmer. He kind of wrote the Bible on systems thinking and complex problem solving, or problem solving in a complex environment. And he had 20 years in the Air Force. I think he was like a rank just below general or something, where he did a lot of this sort of stuff in a logistics capacity. But then he spent decades after that consulting to Fortune 500 companies, educating executives in systems thinking and frameworks and analysis and strategy evolution. Read all these books, studied everything in that field effectively, but discovered he was coming out to Australia to run one of his sort of exclusive executive level workshops. So reached out to him. I was quite young back then, and just said, look, could you let me do this workshop? Like, I'll even just carry coffees, go get coffees for everyone or whatever. Anyway, he was kind enough to let me come in and actually end up being a full participant in that workshop. Got schooled in all of this stuff. I was well out of place. There was, executives of different listed companies, whereas I was just this much younger version of me. Previous, like in the lead up to that, I'd done a lot of, because I kind of realized that, look, the ultimate complex system is the world, right? And all of this stuff works and so well. And a lot of his principles was evolved out of physics foundation by a physicist by the name of Eliyahu Goldratt. Yeah. Applied amazingly to complex systems and environments like businesses. And I figured, well, if it works so well there, it should work great in the ultimate complex system that is the world. Yeah. So I did a whole heap of analysis in that space. And when I did that workshop, it would be like, Bill, have you ever heard of anyone applying all of your stuff to the economic system or the markets or the global environment? And he's like, no. Anyway, at the end of that workshop, he invited me around to spend an hour with him on the Saturday before he flew out of the country again. That hour turned into like 5 hours. I walked him all through the systems analysis of the environment, of the broader economic and financial environment, sort of showing him how his framework applied in that setting. Wow. We became quite good friends, but then every month after that, and then especially later through 2008, when a lot of what was just naturally inferred about the next system so this system was breaking down and transitioning into the next system, that ended up being that 2008 environment. Bill would send me an email every few months going, Daniel, this is actually unfolding exactly like that analysis implied it would. And, and I'd respond back, it's like, yeah, I'm surprised too, like, that's crazy. Anyway, so we became good friends, and basically he became a mentor in the years following, which was just fascinating, and so further refining and understanding how all of this stuff works, how to think properly, how to approach all of these different things in different applications, has just been profound.
What an incredible schooling and education you've had under mentors such as Bill, and I know you've had many other great mentoring relationships with people with equal expertise in other fields as well. And so getting back to this discussion that we've had today about protecting wealth, so much of what we've talked about has been about wealth protection, but can we talk in future, and maybe in the next video, a little bit more about how we generate returns and attractive returns, healthy returns, using the same systems and core principles that are the foundation of much of your business in the future. We'll discuss that in the next video.